Okay, so the next topic of discussion is the matter of life insurance. And as we look at life insurance, there are obviously, each of you are going to find many different kinds of needs for this, depending on your own circumstances in life, if you have children or not, whatever. I'm going to turn this portion over to Chris Andrews, who has vast experience in offering life insurance from that quiet company, Northwestern, and he's going to fill us in.
World Series Game 7, talking about life insurance, close call. Close call. Let's put this guy here. Sorry. Fiddling. Cool. All right, exciting world of life insurance. So I've been a financial planner affiliated with Northwestern Mutual for the last 10 years. I started that when I was 25. I had 3 years in consulting and then came into this business. And insurance was one of the things I started with. And life insurance in particular, it's an important one. It's like the total dark, terrible thing to think about. It's usually a worst case scenario for a lot of us of what we imagine. But the idea is how to think about wrapping our minds around what our needs might be, or how to think of this as part of our planning. I like to think of it as offense and defense when it comes to financial planning. Offense is your retirement savings, your investments, the money you're going to put aside for all the things that you want to accomplish, both for you and for your family. Defense, the risk management we're talking about today, how do we make sure that if life throws big curveballs, we're prepared? One thing about insurance that I think is a good way to mentally wrap your minds around it, it's a known loss to offset the financial impact of an unknown potential loss, or a potential loss, right? So when you're buying insurance, whether it's health insurance, life insurance, disability, if you end up not needing it for that service to go to Vaden, you're having a known loss, but it's protecting you against the possibility of some bigger thing that could come along, right? So when we think about life insurance, what do you guys think are the main reasons that people would get it? So what do you think are the triggers where someone gives me a call or asks a friend and gets referred? What do you think are the things that come to mind as why you would want to have life insurance? What would you want it to cover? Yeah. Nice. Yep. Any others? Yeah, go ahead. Yeah, loss of salary, so like income. Yep. Oh, he stole it. Yeah. When we do kind of trainings, this is totally dark, but there's like, debt, income, or like if you have kids, it's like education. So those tend to be the three main buckets, and conveniently spell something that's easy to remember. So yeah, those tend to be some of the main ones, right? But yeah, those are some of the big deals. I would also say, oh yeah, go ahead. Absolutely. I'll get to that in a sec. It also is, let's say that I'm taking care of my parents. They don't have enough money for their own retirement, or they need care as they get older. Any version of a dependent, you may want to have some replacement income or money available to help them as well. Debt is not always just the non-forgivable kind, but my mom and dad helped front me to get through undergrad. If something happens to me when I'm 25, 26, and they're still floating those student loans, that would be a nice way to make sure that they're not on the hook for that, right? So there's all sorts of ways to think about life insurance. The biggest triggers for why people tend to look at it are getting married, because now you have a joint financial situation, having a kid, or taking on some new financial responsibility like buying a house. Those tend to be the reasons that people bring it up. What is life insurance? Put simply, it is a specific dollar amount that will pay out if or when you die, depending on the type of product that you buy. So we'll get into some of the differences between those, but it literally is a contract with a life insurance company where you're basically saying X amount of dollars will pay out if something happens to me. So yeah, how do I usually like to think of this? How many of you guys are familiar with like present value calculations? So like, yeah, okay. So that's the idea being, for most clients, income is the biggest thing. Right now, based on what I earn, I'm covering mortgage for the house. My wife's a full-time mom with our 2 kids. We're saving for college. We're saving for retirement. We're paying for preschool for one of them. So we've got a lot of different things going on. But if my income shows up to the house, as long as my income's coming in, we can meet our obligations. So one simple way to think of how do I at least get a baseline of how much insurance I need is to say, okay, well, if I at least want to cover that level of income while the kids are at home, what is the present value of the next 20 years of what I'm going to earn? And I can use that as a way to back into a number that would make the world go round for the family. So put another way, if it was, let's say someone makes $100K a year. They don't really get to take home $100K, right? Because the IRS is going to take a chunk of it. So that maybe turns into $70K. What is the value of that $70K salary over if you had another 20 years of that $70K? How much money would I need today to spin off that $70K for the next 20 years to keep things moving? That's the idea of coming up with that present value calculation. There's all sorts of calculators that you can plug it into, financial calculator or online calculators that make that really simple. The answer is, if you assume about a 3% interest rate, you would need about $1 million of insurance. So if something happened to me today and I was earning $100K to support my family and I wanted 20 years to be covered of the equivalent of that, insurance pays out tax-free, so that's why we're going for this after-tax number. I'd need about $1 million of insurance. So then I'd have to think about, how do I get to that number? Is that all making sense so far? I know it sounds very straightforward, but people get kind of spun out on this stuff because it's usually thinking about something that's not very comfortable. Now, you don't need all of your life insurance to come from the same place. So first of all, what are the different types of life insurance? The way the companies price it, I'll draw a little graph over here. Think of it this way. You've heard of actuarials, perhaps. There's a curve of mortality, and it's often along this idea of age. So if you think of a group of people and the rate at which they pass away, it kind of goes up slowly and then hockey sticks, right? In terms of what would set the price of insurance. If you're 90 years old and you want to buy 100 grand of insurance, the cost is going to be very different than if you're 25 and you're buying a cost of insurance. They also have different curves in terms of pricing based on how healthy you are. So your health, they poke and prod you when you apply for insurance, or at least ask you some health questions to get a sense of what it is that you would qualify for, which curve you're on. One of the key things about insurance is once you buy it, if you're buying it as an individual, that health insurance or that curve that you're on is locked in. They can't come back later and say, well, you're not as healthy as you used to be, we're going to charge you more. There's a benefit to locking it in when you're young and healthy. So that's what we try to help clients think through is what is the amount that they need today? Usually it's tying back to income as the primary driver, and then thinking about, okay, which curve lines up, which one can you qualify for based on your health situation? Because everyone's got a little different scenario there. In general, any idea, so if we think about term life insurance, does anyone know what term life insurance is? No? All right, it's the one that you probably would be most familiar of. It's the if something happens. For a term of time, you're essentially renting a death benefit. So let's say that 25-year-old Chris got married and 30-year-old Chris has kids. If I want to have insurance that lasts for 20 years while my kids are at home, I can buy a term policy. Now, one way that I can pay that price over those 20 years is to have an annually renewable contract. I just pay a larger amount every year based on my age, right? So minimum up front, a little bit more every year. Or you can pay a level premium. So you pay a little bit more in that early year, but it stays level for those 20 years. So this kind of overpayment that you did here helps subsidize the fact that it's a lot cheaper when you're older, when the actual expense of the insurance is higher. Does that kind of make sense? So term is temporary. It's good for a temporary need. Something like when my kids are grown up, I may not need as much insurance anymore. Because once they kick me out 20 years from now, if I want to go back and get some more coverage, I'm going to be up at this price point, right? So term is good for temporary needs. Permanent insurance is another kind. It's one where also you would pay higher here for a fixed period of time until you'd be done paying premiums. But this excess contribution in the early years is invested by the insurance company so that you get a death benefit no matter when you die. It's kind of like buying a house instead of renting a house. Yeah.